Anthony Grasso here, bringing you financial news you can use. In this video series, we're going to go over compliance-related topics. I am a CRCM designation by trade. I am a compliance professional out there. And today we're going to go over the qualified mortgage definition under the Truth in Lending Act, Reg Z. We're going to go over the final rule that came out by the CFPB back in December 20th, 2020, just a few weeks ago, and it's amendments to the ATR QM rule and the seasoned qualified mortgage loan definition. So let's get right into it. All right, so this rule becomes effective March 1st, 2021. And we're going to go over an executive summary of the rules. So this isn't a fine-tooth comb, line by line of the regulation. If you like to know specifically line by line, leave your comment down below on specifically what you'd like me to go over more in detail. So to summarize it, the general qualified mortgage final rule, it replaces the existing 43% debt to income ratio limit on the general qualified mortgage definition with price-based thresholds. And it does make other changes to the ATR QM rule, and we're going to get into that. There's also the second rule that came out, and it's the seasoned qualified mortgage final rule, which creates a new category of qualified mortgage called the seasoned qualified mortgage. All right, so let's go over some background of what currently is in effect before these final rules actually took precedence. Creditors are required to make a reasonable good faith determination of a consumer's ability to repay a residential mortgage loan, and the rule provides certain protections from liability for residential mortgage loans that meet the ATR QM rules requirements for qualified mortgage. And we're going to refer to qualified mortgages and ability to repay as ATR QM. And now there's also different categories of qualified mortgage. There's also some certain exceptions to this, but we're not going to get into everything. This is just a generalized executive summary from the CFPB that I put into a PowerPoint presentation that I want to explain to you. Okay, now currently for a residential mortgage loan to fit within the general QM category, the ratio of the consumer's total monthly debt to income ratio, which in the industry we call the DTI ratio, must not exceed 43%. And the creditor must calculate, consider, and verify debt to income for purpose of determining the consumer's DTI ratio using the standards contained in Appendix Q of Regulation Z. All right, so what I'm going to do a spoiler alert right here. Appendix Q is being wiped out, but we'll get into that later in the video. All right, so general QMs must comply with the ATR QM rule. Prohibitions on certain loan features, points and fees limits, and underwriting requirements. Now there's a category of QMs called the temporary category of GSEs of QMs. It consists of residential mortgage loans, among other things, or eligible to be purchased by guaranteed by Fannie Mae or Freddie Mac. Collectively, these are known in the industry as the government-sponsored enterprises, and we're going to refer to government-sponsored enterprises in this video as GSEs. Now, there has been a temporary GSE QM patch that passed, and we're going to get into that patch in a little while. And the temporary QMs must comply with the ATR QM rule prohibitions on loan features and points and fees limits, but different than the general qualified mortgage rule, they do not need to meet the 43% debt to income ratio. Now, the patch that I was talking about temporary QMs, the Bureau is the CFPB. It replaced the January 10th, 2021 sunset date. So it was initially going to sunset those provisions on January 10th for the temporary GSE QM category, and with the provision stating that the temporary category will be available only for covered transactions for which the creditor receives the consumer's application before the mandatory compliance date of the final amendments to the general QM definition. And that definition mandatory compliance date is July 1st of 2021. So it's only going to be available for covered transactions until July 1st, 2021, unless up to that point, they extend it again or make any amendments to it. But as of right now, that patch for temporary GSE QM designation will expire July 1st, 2021. Now, well, the patch extension final rule, it didn't cover a few things. So it did not amend the provision stating that the temporary GSE QM category expires with respect to the GSE when that GSE exits conservatorship. So that was one of the big provisions. It's like, okay, at some point, they project that the GSEs, Freddie Mac and Fannie Mae, are going to exit conservatorship that they're currently under. But it did not amend that provision. It also did not amend any QM definitions that apply to FHA loans, VA loans, USDA loans, or rural housing loans. Okay, so now the amended general QM definition in the final rule, it replaces the 43% debt to income ratio with a price-based limit and removes Appendix Q, as well as any requirements to use Appendix Q for general mortgage loans. Now, if you don't know what Appendix Q is, it laid out all the standards for determining the monthly debt to income ratio, and you can find that on the CFPB's main website under the regulation for Regulation Z under the appendixes. Now, the general QM rule does retain ATR QM's rule to consider and verify requirements, but clarifies how they apply under the revised general qualified mortgage definition. We'll get into detail about the consider and verify requirements in just a few minutes. Now, the general QM rule also retains the existing product feature and underwriting requirements and limits on points and fees, so that did not change. Now, the price-based limit, a loan meets the revised general QM definition only if the annual percentage rate APR exceeds the APOR, which is the average prime offer rate, and I'm going to get into where you can find that, or a comparable transaction by less than the applicable threshold set forth in the general QM final rule as of the date of the interest rate is set. Now, you're going to ask, okay, well, where can I find those APOR? Because if you're a compliance professional on either on the primary market or on the secondary, you're going to have to maintain the APOR tables, and I will show you exactly where to get those. And generally, the threshold is around 2.25. No, not generally. It's normally 2.25%, but in the next slide, we'll get into the variations of that. Now, the general QM final rule provides higher thresholds for loans with smaller loan amounts for certain manufactured housing, and I'll get in the definition of what manufactured housing is, and for subordinate lien transactions. Now, the average prime offer rate is published by FFIEC, which is the Federal Financial Institutions Examination Council, and there's a website right there that has the tables. So if you're on the primary market, you're gonna just focus on the top two tables. But if you want to go in historical records, if you're on the secondary market reviewing securitized transactions, or you want if you're doing due diligence work, you're going to have to look up the historical records, which is right there. So just go to that link, and then you'll get those tables, and it's an Excel spreadsheet. Now, the threshold set forth in the general QM rule, now these are adjusted annually for inflation. So every year when these tables come out, you're going to have to adjust what these numbers are. And as you can see here, for first lien loans above $110,000, which most on the primary market, if you're doing mortgages right now, you're mainly going to be doing loans above $110,000, and it's 2.25 percentage points spread. And it goes up to 3.5% if it's between $66,000 to $110,000, 6.5% for if it's loans under $110,000. Now, for covered transactions for manufactured homes, and manufactured homes, in the legislation, in the rule, it's either a manufactured plus the land, or it's just the manufactured home itself. So you can secure it just with the home, or home plus land, and it's 2.25% above 110,000. Below that, it's 6.5%. And then with subordinate liens, that's your second mortgages. You have 3.5% to 6.5%. Okay. So, and I included the definition of manufactured home here for you, so you can read through that. You can just pause it if you want to, if you deal with compliance issues on manufactured homes. I included the actual regulatory definition uh, for manufactured home. You can find that in 12 CFR 3280.2. And one of the things here I want to note is that at the very bottom it says modular or other factory built homes that do not meet the HUD code standards are not manufactured homes for this purposes. So the manufactured home has to be specifically within the definition for you to consider a manufactured home under the general QM final rule. Okay. Now, if the loan's interest rate may or will change in the first 5 years after the date on which the first regular periodic payment will be due, you have to treat the highest interest rate within the range for the first 5 years. And I'm going to explain how you can calculate that. Think of adjustable rate mortgages or step rate mortgages, but you have to determine the highest possible APR within the first 5 years. And you're going to look at the note. So for that information, to calculate where that will fall from. And typically your loan software systems are going to be able to calculate this for you. Just input what's on the note into your system and it should calculate it also. And there's also websites online that give you that information as well. Now, well, let's go into the interest rate adjustment caps. Now, for adjustable rate mortgages, creditors should assume that the interest rate increases after consummation as rapidly as possible. So when you calculate within the first 5 years, you're going to say, okay, well, here's the interest rate caps that the maximum it could reach at every step of the way, and you're going to have to look at the legal obligation, which is the note. So creditors should account for any periodic interest rate adjustment cap. They may limit how quickly the interest rate can increase under the terms of legal obligation. And I included a link down there because there is a lot of information from the CFPB. This is specifically the commentary by the CFPB. So if you want to look into that, go right ahead. Now let's go into the consider and verify requirements of the General QM final rule. Now, the revised General QM definition retains and considers the verify requirements. Okay, so creditors must consider the consumer's current reasonable expected income or assets. You don't take the asset of the dwelling that you're securing, debt obligations, alimony, child support, and DTI ratio residual income. The revised QM definition retains the verify requirements that you must verify the same information, the income, assets, debt obligations, alimony, and child support. And the creditor must verify such amounts using reasonable, reliable third-party records and reasonable methods and criteria. A creditor may only consider amounts that it is verified in accordance with verification requirements. So in your policy and procedures, it's going to list out your company. And if you're the compliance professional, you're going to set these standards for the financial institution that you currently work for on what is reasonable third-party records. And it will be probably kicked up to you and as the compliance professional to determine what is a third-party record. All right. Now, however, the General QM final rule does not prescribe how a creditor must consider the monthly DTI ratio or residual income, a particular monthly DTI ratio residual income threshold, or specific methods of underwriting that a creditor must use, other than to require the verification methods and criteria must be reasonable. And that goes to your policies and procedures on what you think is reasonable, and you're going to have to explain that to your regulator. You might have a state regulator, or you might have a national regulator, or the CFPB might come down on you. Furthermore, the General QM final rule provides flexibility, and then there's official commentary specifically on that for a creditor to take into account additional factors that are relevant in determining a consumer's ability to repay. Now, to prevent uncertainty that may result from Appendix Q's removal, okay, so since Appendix Q's being wiped out off the face of the earth, the CFPB is like, okay, well, we need to provide some standards here. The general QM final rule clarifies that the consider and verify requirements in a revised general QM definition. For example, the general QM final rule clarifies to meet the requirements to consider, a creditor must: 1. Take into account current reasonable expected income or assets, the debt obligations, alimony, child support, and monthly DTI ratio or residual income in its ability to repay determination. And this is where you as a compliance professional is going to maintain written policies and procedures for how to take that into account. And then you have to retain the documentation showing how it took into account all that information. Now, when you retain the documentation, let's say you work on the primary market, that documentation now, when it goes to the secondary market and it's, let's say it's securitized, those due diligence firms will take that documentation and confirm that you're actually followed your written policies and procedures on how you specifically followed to get to those numbers. Okay. Now, a list of specific verification standards that creditors may use to meet the revised general QM definitions verify requirement. Now, you have to satisfy one or more of the specific manuals listed on this slide. You can pick and choose. You don't have to just pick one. You can pick some standards from the Fannie Mae guide. You can pick some standards from the Freddie Mac guide, FHA, VA, and USDA. As long as you take the standards for verifications from this, and it has to be from a certain manual, like has to be from a certain date. So the CFPB will say, okay, well, the Fannie Mae single family selling guide from this specific date version. So they'll give you the versions that are approved. And if that version is now revised, you can say, okay, well, I use the revised version that's now new and approved. So you can't use the old versions. You have to use at least the version that the CFPB says is a allowable version of it. Now there's other amendments in the general QM final rule. Now, the general QM final rule also clarifies that a creditor does not meet the verification requirements in the ATR QM's rule general ability to repay if the creditor observes an inflow of funds into the consumer's account without confirming that the funds are consumer's personal income. Now, here's an example they give where you can possibly have somebody take out $100,000 loan, and let's say they want to try to say they make, let's say $120,000 a year or more. So they put that money into a separate account and every month deposit $10,000 into the account, and then give the bank statements to you as to say, okay, well, I have bank statements with $10,000 deposits every month, and they're claiming that it's personal income. Well, you're gonna have to trace down where did that money come from and verify that. So you're gonna have to use verification processes, and it's gonna be easy to track down any kind of fraud. So there are ways to determine if somebody's trying to defraud you to try to get a mortgage loan or any type of loan and saying, well, I make all this income, but no, you really didn't. You took out a loan, you put it over here, and you're depositing money into the account. So check out for the fraud that goes on. And there's definitely a lot of fraud. I just talked to my fraud analyst buddy the other day at one of the big banks, and he was like, yeah, he goes to court on that. And I'm like, I really don't want to be going to court over things like that. Okay, so now the general QM final rule preserves the ATR QM rule's current threshold, separating the safe harbor from rebuttable presumption QMs. And now under that threshold, a loan is safe harbor QM if the APR exceeds OPAR for a comparable transaction by less than 1.5% for a first lien transaction, or 3.5% for a subordinate lien transaction. And I showed you that table in the previous slide, so that's where you can see if it's a safe harbor QM loan. So, however, the general QM final rule creates a special rule for general QM loans for which the interest rate may or will change within the first 5 years after the date on which the first regular periodic payment will due. For such loans, the creditor must determine the APR for purpose of this threshold by treating, as we said again, the maximum interest rate you can apply during that 5-year threshold. So when you're looking at the safe harbor rule, you still have to take in the maximum interest rate over the first 5 years. And if it fails that 1.5% or 3.5%, you're no longer a safe harbor QM. And the general QM final rule also makes conforming changes to the regulatory text and commentary. Now, I'm not going to go over specifically the red line version of the regulation. Please leave a comment down below if you want me to explain in detail any very one specific, because any one specific topic I can talk for about 30 minutes to an hour on. We're just giving you the general executive summary that was given from the CFPB, and I put it together in this PowerPoint presentation. So I provided a link down there from the CFPB that you can go over the unofficial red line, which is going to, as of March 1st, they're going to, it's going to take into effect. And one thing to note is the general QM final rule does not affect the QM definitions that apply to FHA, VA loans, Department of Agriculture, or the Rural Housing Service loans. So it doesn't affect the definitions under them. Okay. Now, as I said before, the effective date that they initially had was 60 days after it was published in the Federal Register. And these both final rules were published on December 29th, 2020. And they specifically said these will take in effect March 1st, 2021. Now, the general QM final rule has a separate mandatory compliance date. So it takes into effect March 1st, 2021, but it gives creditors and financial institutions up until July 1st, 2021. So remember that date. Even though it takes into effect, you have to mandatory comply with all the regs by July 1st, 2021. All right. Now, the second rule, so there was two final rules, the general QM rule, and then now we're going into the second final rule, which is the season QM final rule. And it creates the new category of QMs called the season QMs. Now, a residential mortgage loan is a season QMs and receives a safe harbor from liability under the ATR QM rule if the loan satisfies a few things. It has to satisfy the product restrictions, the points and fees limits, the underwriting requirements, and if it's held in the portfolio until the end of the seasoning period, which is it's subject to some exceptions, but generally think of 36 months and held in the portfolio, and meets certain performance standards at the end of the seasoning period. Okay, so a loan made by any creditor, regardless of size, is eligible to become a season qualified mortgage if at the end of the seasoning period it meets the requirements in the season QM final rule. So any loan can fit into this category if it follows the actual rules in this final rule. Now, that loans that satisfy another QM definition at consummation can also be a season QM loan as long as the requirements, as I said, are met. Now, here's the product restrictions and the points and fees limits. So the loan has to meet the following product restrictions to be eligible to be a seasoned QM. Okay, so first, it has to be a first lien. If a loan is a subordinate lien, it is not going to be eligible for it. Now, the loan has to be also fixed rate. Adjustable rate mortgages, unfortunately, and step rate mortgages are not eligible to be seasoned QMs. The loan has to have a regular, substantial, equal periodic payment that are fully amortizing, does not allow for negative amortization, and does not have a balloon payment. A loan has fully amortized payments if periodic payments of principal and interest will fully repay the loan over the loan term, and you cannot exceed the 30 years. So 40-year loans are not going to cut it. Any balloon payments, not going to cut it. Negative amortization, not going to cut it. So we're looking at your primary first lien fixed rate mortgages that amortize over 30 years. That's mainly what you're going to see. And the loan cannot be a high cost mortgage as defined in section 32A, which is Reg Z 32A. And there's the link down below. Now, additionally, the total points and fees for the loan cannot exceed the limits specified in the ATR QM rule. We're not going to go over those specific limits, but you can just look at the reg for the breakdown of the points and fees limits. They break it down, but we're not going to get into it in this video. Generally, this means that the total points and fees cannot exceed 3% of the loan amount. So generally, it's 3%, but definitely look in the regulation for the specific breakdown of those amounts, and your origination systems or due diligence, secondary due diligence systems should already have this programmed in there. You just type in the numbers and the computer screen tells you if it is or is not. Now, these product restrictions do not prohibit a qualifying change that is entered into during or after a temporary payment accommodation in connection with a disaster or pandemic-related national emergency. So basically it says if there's national emergency and we have to change this, well, there's conditions for that, so it won't affect the season QM definition. If it's a qualified disaster, that's okay. Now, the underwriting requirements. For a loan to be eligible to be a season QM, the creditor must consider verify requirements for the loan. Now, we already went into the consider and verify requirements, but it's basically the same. The consumer's DTI ratio, residual income, income and assets, and debts, and verify the same thing. Now, using and consider and verify requirements established under the general QMs is what you will use. So that's what you're going to use to verify those requirements. Okay. And the portfolio requirements. So how long you have to hold it onto your books for, basically. Now, in order to be eligible for season QM, a loan must meet certain portfolio requirements. And it's if at consummation, the loan is not subject to a commitment to be acquired by another person and the creditor holds the loan in portfolio until the end of the seasoning period. So that's generally, like, if you hold in your portfolio, you will hold it from consummation for 36 months. Now, there are exceptions to these portfolio requirements, and I will specifically get into them specifically. So exceptions to this, now, for example, if you allow transfer pursuant to supervisory sales or pursuant to certain mergers and acquisitions. Second, the season QM final rule allows for single transfer during the seasoning period if the loan is not securitized as part of a transfer or at any other time before the end of the seasoning period. Now, you can only use this exception once. So this means if the loan is to remain eligible to season QM, a purchaser that acquires a loan pursuant to this exception may not subsequently transfer it to another entity unless a different exception applies. Additionally, the loan may not be securitized before the end of the seasoning period. So think about a correspondent who will get it off its books because correspondents do not hold the portfolio of mortgages. They immediately sell it off. So that first buyer from a correspondent will hold it onto its books. And if they hold onto its books for the 36 months, they will be eligible for the season QM definition, as long as they don't securitize it in the meantime. So the performance requirements, now there cannot be 2 delinquencies of 30 days or more, or no delinquencies of 60 days or more at the end of the seasoning period. And how you calculate that, if the due date is the 1st, so you'll take the 1st plus 30 days. So if they don't make that payment, and you don't take in consideration the like the 15-day grace period. So if you don't, you can pay for it up until the 15th. You don't go from the 15th 30 days. You go by the due date of the legal obligation. So the note, if the due date is the 1st of every month, it's going to calculate it from the 1st 30 days out. All right, so now when determining whether scheduled periodic payment is delinquent for the purposes of the due date is under the terms of legal obligations, we basically went over that. All right. And this goes into more of the performance requirements of calculating the 30 days delinquent, the 60 days delinquent. I'll let you read through that, but it's basically saying that it gives you an example of how to calculate that amount. Now, funds taken from escrow and funds paid on behalf of the consumer by the creditor, servicer, or assignee of the loan are not considered in assessing whether the periodic payment has been or is delinquent for the purpose of the season QM final rule performance requirements. So creditors can, however, generally accept deficient payments within a payment tolerance of $50 on up to 3 occasions during the seasoning period without triggering a delinquency for purposes of the performance requirements. So let's say somebody owes $1,000 and they pay $950. Well, so you can have a deficiency of $50 tolerance. You can do that up to 3 occasions, and they won't consider that part of the late delinquencies. Now, this exception to the definition of delinquency in the season QM final rule only applies, however, if the creditor does not treat the payment as delinquent for the purposes of the mortgage servicing provisions, subpart C of Regulation X. So you can't tell the consumer that you are delinquent 30 days. You can't treat it as a delinquency with the consumer. So the consumer you just say, well, you owe this, add it to your next payment. You're not, it's not considered as a delinquency. Now, in order for a loan to be a seasoned QM, it must meet certain requirements during or at the end of the seasoning period. Generally, the seasoning period is the 36 months that begins on the date which the first periodic payment is due after consummation. Now, if you're in compliance, consummation and closing date doesn't necessarily is at the same day. You can have in some jurisdictions, and I'm not going to go into all of them. Well, some jurisdictions, they have a consummation date that is after the closing date. So you can have a closing date, and then you can, the consummation of that mortgage is after. A lot of places, there is nuances with that. So I'm not going to get into that. Just know it's 36 months of the first periodic payment after the consummation. Now, first, if there's a delinquency of 30 days or more at the end of the final month of the seasoning period, the seasoning period is extended until there is no delinquency. Second, time spent in a temporary payment accommodation extended in connection with the disaster pandemic-related emergency does not count towards the seasoning period. Okay, remember that. Additionally, the seasoning period can only resume after the temporary payment accommodation if any delinquency is cured, either pursuant to the loan's original terms or through qualifying change. Okay. So, and the last thing we're going to talk about is the safe harbor. So, seasoned QM final rule provides a safe harbor for seasoned QMs, regardless of whether the loan is a higher price loan or not. So, it can be a higher price loan, and it will consider itself a safe harbor. And the effective date of this is the same as the other final rule. It's effective March 1st, 2021. Its revisions to the ATR QM rule apply to cover transactions for which a creditor receives an application on or after the effective date. The CFPB expects the general QM and seasoned QM final rule to take in effect on the same date. So that's March 1st, 2021. So there you have it, guys. That is the breakdown. That's the executive summary of the final rules that came out from the CFPB. Now, please leave a comment down below if you'd like me to go over specifically any aspect of these rules or any compliance topic in general. So I'm going to be making videos on compliance-related topics, and I will explain it to you from a CRCM. So if you like this video, smash that like button down below and consider subscribing. If you like financial news you can use, I'll be having playlists on stock market investing, real estate investing, and compliance issues. So smash that like button down below, and I'll be checking out you in the next video. Ciao.